What's going on, money lovers? Welcome back. So today's episode is going to be part of the Invest Like the Best series, where we're going to continue discussing Peter Lynch and his book, One Up on Wall Street. Got it right here. Great book. Highly recommend it. So if you didn't see the last video, I will link it in the description below. Definitely check that out. So today we're going to jump into preparing to invest, whether it's for the first time or whether you're looking to invest in new companies. This is all going to be great info for you, and you don't want to miss this. So let's get started. So Peter Lynch gives a chart of many of the big winners of the 1990s, and even though the book is a little dated, the principles definitely still apply. Believe me. So the companies that stood out to me were ones like Microsoft, Home Depot, Lowe's. These were all companies he talked about. They were around in the 90s and thriving. They're still around today. They've withstood the test of time, and I can see all three of these companies continuing to thrive for the foreseeable future. You look at Home Depot. This is a company that never really excited me too much, but I'm starting to come around to it because you think about Home Depot and you look at this chart. Chart looks nice, dividend looks nice. Home Depot is a company that has withstood the test of time, and besides Lowe's, you know, Home Depot and Lowe's really are this niche market where Amazon can't really ship the things you get from Home Depot. People are always going to need to be doing home improvements and construction projects. Where are they going to go? Home Depot and Lowe's. People are going to be going to Home Depot and Lowe's for as long as I can see. So that's the type of company you want to own. It's a niche. Who can really challenge them? Is Amazon going to be able to ship 10 5-pound 20 by 10 pieces of wood? Not easily. Not in the near future, and they're great dividend stocks with a great history of rewarding their shareholders. And I'll also link in the description below my video on dividend investing, which if you haven't seen it, check it out after this and you'll be as excited about dividends as I am. And you look at the chart for Home Depot, for Lowe's, you know, they just keep going up over time. And then a company like Microsoft, who's Microsoft's biggest competitors? As they're shifting to the cloud software space, Amazon, maybe IBM, they're here to stay. Until something changes, these are the companies you want to be in. Lynch also says how in the end, superior companies will succeed and mediocre companies will fail. So that's like Warren Buffett has said, it is better to get a great company at a decent valuation than to get an okay company at a better valuation. Because in the long run, the best companies will prevail. Pretty self-explanatory. So another thing that really resonated with me, Lynch talked about how investors tend to be optimistic and pessimistic at precisely the wrong time. And you've probably seen this play out time and again if you've been investing for a while. If you're brand new, what you're gonna see, and you're probably gonna have to catch yourself doing this, trying to predict, trying to time the market. Oh, I think there's a crash coming, or, you know, I think that this is going to be a great year for the market. You need to discipline yourself to just get away from this way of thinking. It's not going to get you very far. Trying to invest in good markets and get out of bear markets is futile. Logic is a lot more important when it comes to investing in the stock market than math is. The only math you need to invest in the stock market, you learned in 4th grade. You know, I've often thought, maybe I missed my calling. I should have majored in business, gotten my MBA. Lynch says how everything he learned, he had to unlearn. This isn't the first time I've heard this, because all these theories they teach you in economics and business school don't actually resonate very well in the real world. Elon Musk says very often, it's good to see, you know, a lot of CEOs now that are engineers instead of MBAs, because the ones who are MBAs tend to just focus on these short-term, quarter-to-quarter profits that Wall Street is focusing on, instead of a long-term vision that's really going to make your company be that superior company that will outlast the mediocre one. So another recommendation Lynch makes is to buy stocks that are out of favor or turnaround stories. So a current one that I've made a few videos on is IBM, which I think can fit this turnaround category. I think the company is going to turn around. But in the last 5 or so years, you know, they've missed out on this great bull market. They really haven't gone anywhere, and it's due to that short-sighted vision. But now the new CEO, he's an engineer. I think he's going to turn around the company, and they're doing a lot of promising things with cloud, AI, and quantum computing. If you're interested, check out my videos on IBM. And this is one of the companies that I've been buying, and they actually have been doing better recently. But I don't care. I hope it stays low so I can buy a lot. I'm looking at this company for 5, maybe 10 years down the road. We'll see where it goes. Another enterprise you can apply this thinking to. Everyone talks about electric and solar, and I do too these days. But I filled up my car the other day. $3 a gallon. I mean, I think gas is here to stay for the time being. And, you know, there's an industry that's out of favor that Wall Street's no longer interested in. If you are interested in, you know, natural gas and oil, things of that nature, maybe you can make it work. Again, not my cup of tea, but it could fit the out of favor category. Or you can invest in a company like BP that is trying to reinvent itself and is transitioning to becoming a green and renewable energy company. So kind of getting the best of both worlds. They're still going to profit from oil somewhat, but they're also realizing oil's days are limited and they're transitioning to green. You collect this nice dividend in the meantime, and it's trading, relatively cheap right now compared to many of the other high-flying stocks. Another company I think would fit this category is Altria. Out of favor, but let's be honest, tobacco is here to stay. They pay a huge dividend, and Altria bought a big stake in Kronos. They have distribution networks set up to where I think if they wanted to, they could become a dominant player in the MJ or cannabis space. That's the long shot, but you're getting that potential upside with a solid, proven business model versus investing in these MJ companies. I'm going to get to this later in more depth because it ties into another thing that Lynch had talked about. So stick around. Now, you should never punish your winners. Good news and good developments for a company is not reason to sell. Don't punish your winners just because you're up a lot. If you had sold Tesla when it was up 100%, going back a year or two now, you would have missed out on the next 900% gain it would go on to achieve. So don't punish winners. Hold on to a company as long as the fundamental story is still intact. Another thing I really like that Lynch said was this idea that investors constantly transition through these three emotional states of concern, complacency, and capitulation, and they're all at precisely the wrong times. Investors become very concerned after the market has dropped, after the economy has faltered, when it's at a low, and they should now be seeing this as a buying opportunity to buy low. But since the investor is concerned, it prevents he or she from buying these great companies at a great low price. Then after, he waits till the market's completely recovered and he pays too much for these companies and he stops paying attention to them. This is when he or she gets complacent. This is exactly when he should be looking on with concern that the company stumbled, it stumbled again. Instead, the investor becomes very complacent. They stop paying attention precisely when they should be paying attention the most. And what ultimately ends up happening, company falls on hard times, stock prices plummet, and the investor then panic sells. This is like the axis of evil in investing. Exactly what you don't want to do. And it's hard because just psychologically, this is how we're built. But you just need to train yourself to be a contrarian. For example, during the pandemic, March, April, I saw Apple and Microsoft, companies that were great and I knew weren't going anywhere, were getting punished during the pandemic. Microsoft, for example, went all the way from 185 to a low of 137. So I started buying companies like this, and I'm now up between 40 and 60% on those positions. Another problem investors tend to have is following their gut feeling. You need to discipline yourself to ignore your gut feelings. Stand by your stocks as long as the fundamental story is still the same. If nothing has changed with the company to make you doubt it, if they're still on track to achieve what you had hoped for when you invested in the company to begin with, then why sell? If the future is bright, why would you sell? Even if it is for a profit. Chances are the company is going to continue to thrive. Another point Lynch focuses on in the book that I really like, this thing he calls penultimate preparedness. He says we're always trying to prepare ourselves for something that's already happened. Instead of trying to prepare ourselves for the last thing that has happened, you need to be focusing on what's going to happen next. Lightning doesn't strike in the same place twice. So during the pandemic, when everyone's panic selling and the market is dropping and companies whose fundamental story has not changed are, losing 30, 40, maybe even 50%, I was buying heavily. And that's how I was able to get positions in Microsoft and Apple and the great companies that I'm now up anywhere between 40 and 60% on. Now, a major mistake, and possibly the biggest mistake that I myself am guilty of doing from time to time too, is we tend to try and predict the market. Don't try and predict the market because there's a 99% chance that the opposite will happen. Whether it's you think a crash is coming, whether you think a crash is not coming, whether you think a company is going to beat earnings, whether it's not. Do not base your investing around predictions. Buy great companies, hold great companies, you will reap the rewards long term. Nobody, I don't care who you are, nobody has a crystal ball that will tell you what's going to happen with stocks from day to day, week to week, or even sometimes a year or two. But generally, 5-10 years out, great companies will have made you a lot of money. And even if you could predict the next booming sector, the next big thing, you still have to pick the right companies. So I look at the MJ sector, cannabis specifically, things like that, things like sports betting, these things that are, industries that are on the rise, that are bringing in a ton of money. But there's many companies that are competing, and it's very difficult to pick the right one. Most likely, in the end, only a few companies will survive, and the rest will no longer exist. So even if you do happen to pick the right market or the right sector, you still need to pick the right stocks or right companies within that sector, and the odds are just stacked against you. So I'd just like to close out with some key points, and if you enjoyed this video, please don't forget to like and subscribe. We've got more great content coming, uploading videos weekly, and in the next section, I'm going to tell you how Peter Lynch picks winners, so you don't want to miss out. So definitely stay tuned, subscribe to the channel. So just some key points here as we wrap up. Don't place a lot in value in the wisdom and opinions of professionals. They're predicting market crash after market crash. If you say something 100 times, eventually you'll be right. But the majority of the time, they know no more than you do. Take advantage of the things that you already know. Like I said earlier, you see in your community what businesses are booming, what stories got a huge line, what are the new hot products. Find out who makes those products and take a look at that company, look at their balance sheet, and if their revenue is growing. The best companies that will make you the most money are the ones that are off the radar, that Wall Street hasn't picked up yet. Companies no one's talking about. Once it's on CNBC constantly, chances are you've probably missed the boat and it could be too late. Obviously there are exceptions, but generally you're going to make the most money before something has hit the mainstream. This is probably the hardest part, is to train yourself to just ignore short-term fluctuations in the market. It's going to go up and down, up and down. Every week there's going to be some crisis, something going wrong, and the market's going to be going down, up, responding accordingly. You can't predict that stuff. There's way too many variables, but through calculated risk, you can invest in great companies who you think in 5-10 years are still going to be around and still going to be thriving. Long-term investing is the only true way of investing. So trying to predict what's going to happen with the economy and the markets in the short term is just a futile endeavor. You're not going to get very far. You do have many advantages over Wall Street. Lynch talks about how, many of these popular products in your local communities and stores, you're going to be seeing them way before they're ever on Wall Street's radar. Just think about how many companies you could have got in early because you noticed a product that's always sold out, things of that nature, before Wall Street's talking about it. All right, so let me know if you enjoyed the video today, and if you have any questions, let me know in the comments below. What do you want to see videos on in the future? This is Vinny from the Investment Club, and I'll see you next time.